Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the Risk Spotlight Portal, the premier forward-looking service for operational risk content. Let's get started. The first significant update this week comes from the UK, where the government has published guidance on the new failure to prevent fraud offence introduced under the Economic Crime and Corporate Transparency Act 2023. Starting from September 2025, companies in the UK can be held criminally liable if a fraud offence is committed by an associated person, such as an employee or a subsidiary. Interestingly, franchisees and entities within the supply chain won't be classified as associated persons unless they directly provide services on behalf of the company. The guidance, based on 6 key principles, like top-level commitment and risk assessment, is meant to help companies implement reasonable fraud prevention measures. It's quite similar to existing guidance on the failure to prevent bribery and tax evasion, so leveraging existing practices might ease the implementation burden. The onus, however, lies squarely on senior management to ensure there's an open culture of fraud prevention and that employees feel empowered to report suspicions. The new offense, with its broad jurisdictional reach that applies even to companies operating outside the UK with a UK nexus, provides a potent tool for law enforcement. It's expected that companies will use the implementation period until September 2025 to strengthen their fraud prevention measures. Shifting gears to North America, BioCatch's 2024 Digital Banking Fraud Trends Report sheds light on a significant increase in digital banking fraud, particularly through social engineering scams and money mule activities. Reported cases of social engineering scams have increased tenfold, and money mule accounts saw a 94% rise, highlighting the growing threat that these schemes pose to North American financial institutions. According to BioCatch, North American banks have made progress in identifying laundering accounts, but the sheer scope of the problem remains challenging. GenAI tools and deepfakes have added another layer of sophistication to these scams. A striking example comes from Hong Kong, where a deepfake scam resulted in a $25 million loss. The rise in AI-driven fraud, as highlighted in BioCatch's ScamGPT white paper, calls for advanced security controls, especially as account opening fraud decreased but deposit fraud spiked in the past year. Meanwhile, UK financial regulators have announced new guidelines to strengthen the resilience of critical third-party providers to financial institutions. The Financial Conduct Authority, the Bank of England, and the Prudential Regulation Authority have been granted new powers to oversee these third-party providers, aiming to reduce potential risks to financial stability. This is a significant step, especially since financial firms have increasingly relied on a handful of critical third parties, which, if disrupted, could have widespread effects on the stability of the financial sector. Interestingly, these guidelines align closely with international standards, such as the EU's Digital Operational Resilience Act. One key point here is that while third-party resilience is being enhanced, financial firms themselves are not absolved of their responsibilities. They remain accountable for managing their third-party risks under existing operational resilience regulations. Now, moving to the U.S., financial regulators are putting increased emphasis on anti-money laundering AML efforts, and Know Your Customer KYC compliance. Recent remarks by officials at the Treasury Department's Financial Crimes Enforcement Network underline the intention to keep financial crimes a high priority. This focus is particularly evident following the case of TD Bank, which was fined $3 billion for violations related to money laundering. Other banks, including Wells Fargo and Bank of America, have also come under scrutiny for their AML programs. These actions show a continued commitment to upholding compliance in financial institutions and taking disciplinary actions where significant gaps are found. On the technology front, Visa and Feedzai have published insights on biometric adoption in the UK and France, respectively, reflecting a growing shift toward biometric authentication for securing financial transactions. According to Visa, 40% of UK consumers are ready to use biometrics for activities like replacing car keys or accessing accounts, and 54% believe biometric methods are more secure than traditional passwords. Similarly, Feedzai's research in France shows a rising trend of biometric adoption, especially among younger demographics, to address increasing concerns around financial crime. This preference for biometrics aligns with growing worries about sophisticated cybercrime tactics and the desire for more robust fraud prevention measures. It's worth noting that older generations are still more hesitant about moving towards digital IDs, highlighting a generational divide that might be key to how banks position these technologies in the coming years. Staying with fraud, the Hong Kong Insurance Authority has issued warning about fraudulent websites and social media accounts impersonating well-known insurers like AIA International and BOC Group Life Assurance. These platforms pose risks to personal information and financial transactions. The updated Anti-Scam Consumer Protection Charter 2.0 aims to tighten security standards to counter cybercrime, highlighting the need for evolving regulatory frameworks and consumer awareness. Let's also touch briefly on developments in quantum security. The U.S. National Institute of Standards and Technology, NIST, has outlined timelines for transitioning to quantum-resistant encryption, with a target of 2035 for government agencies. Analysts, however, are urging businesses to move much sooner, given that quantum capabilities might be achieved as early as 2028. This timeline poses a potential risk, particularly given the threat of harvest now, decrypt later attacks. Organizations are encouraged to act promptly to ensure sensitive data remains protected in the long term. The new approaches recommended by NIST, including the module lattice-based key encapsulation mechanism, are seen as essential steps toward bolstering cryptographic strength. Finally, Google Cloud's cybersecurity forecast for 2025 paints a picture of a rapidly evolving cyber landscape, driven by AI both as a tool for defenders and as an asset for attackers. AI's influence will be substantial, leading to new semi-autonomous security operations that could enhance both the detection and prevention of cyber attacks. However, the rise of AI-powered cyber attacks, including sophisticated malware and deepfake-driven social engineering, is set to increase the complexity of defending against these threats. Geopolitical tensions are also a major factor, particularly with cyber activities linked to actors from Russia, China, Iran, and North Korea. The report serves as a call to action for organizations to bolster their cybersecurity defenses and prepare for a more complex and adversarial threat landscape. Now let's turn to key operational risk loss events reported last week. The next update is about Metro Bank facing a hefty fine for financial crime failings. The Financial Conduct Authority, FCA, in the UK has imposed a £16.67 million fine on Metro Bank for serious shortcomings in its anti-money laundering systems between June 2016 and December 2020. During this period, the bank failed to adequately monitor over 60 million transactions worth more than £51 billion due to a fundamental error in its automated transaction monitoring system. The FCA criticized Metro Bank for allowing these failings to persist for too long, potentially leaving a gap in the defense against criminal misuse of the financial system. The next update is about Navy Federal Credit Union facing hefty penalties for charging illegal overdraft fees. The Consumer Financial Protection Bureau, CFPB, ordered Navy Federal to pay over $95 million for surprise overdraft fees charged between 2017 and 2022. This includes over $80 million in refunds to consumers and a $15 million civil penalty. The credit union charged fees even when customers had sufficient funds at the time of purchase, collecting an average of $44 million annually through this practice. The next update is about ING Bank experiencing another significant service outage. Australia's fifth largest bank, serving over 2 million customers, faced a service disruption that left many unable to access their accounts or complete transactions. This outage, occurring just weeks after a similar incident in October, sparked frustration among customers who reported issues with mobile banking access. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.